Welcome back to the Raw Selection Private Equity Podcast. Joining us today is Nayef Perry, Head of Direct Credit at Hamilton Lane. We're going to dive into what they see for the credit sector, how that links to typical private equity, and a lot more. Let's dive in. Nayef, if you can share a brief insight into you, please.
Happy to do that, Alex. So I was born and raised in Miami, which is where I currently reside. And I attended the George Washington University for my undergraduate, spent some time in management consulting after that, before going back to business school at the Thunderbird School of Global Management. And then I ended up spending 5 years at G Capital in their sponsor-backed middle market leverage finance business, which is consistent with what I do today. And in July of 2013, I joined Hamilton Lane as a vice president. Today, I run our global credit business and sit on our investment committee.
Perfect. So with interest rates forecast to decline, have investors missed the golden era for private credit?
I don't think so. I think our perspective is this golden era has room to run. And, as you think about the why behind that, it probably boils down to a few different things. So number one is, I think as listeners have probably read about, we are in a higher for longer interest rate environment. And so what that means is if you look at 2022 as sort of the line in the sands, when interest rates started rising, the period before that, or let's say the decade before that, if you think about a unit of risk that you would have taken in that time period and compare that to the same unit of risk you're taking from 2022 and beyond for, let's say, the next decade, our view is that investors should be poised to benefit from at least 200 to 300 basis points of more yields over that time period. And so we think that from that perspective, it's obviously a very attractive time for investors to be leaning into the asset class.
Interesting. So with private credit has grown tremendously since the kind of great financial crash, 2007, 2008. Like everything in private equity and other asset classes, does that mean that it's now starting to get a bit crowded and heavily competitive?
It's certainly expanded since the global financial crisis. I think if you were to look back in time for a moment, pre-global financial crisis, private credit was largely mezzanine and distressed credit. And as regulation took hold in the wake of the GFC, we started to see the introduction of senior direct lending into private credit. And from there, we started to see the asset class just continue to grow in a big way. And so if you're an LP, continuously meeting with investors in hopes of finding the right managers and funds, I think at times it's an asset class that can feel crowded. But I think when you take a step back and just look at some of the market fundamentals and some of the data, you see that there's actually a supply-demand imbalance between the amount of private credit capital that's available and the amount of demand. So if you were to look at the data, and we can, we have some of the data in our market review information, which we publish each year. But if we were to look at the data as of 2024, there was roughly a $1.4 trillion gap between the amount of buyout equity dry powder that was raised relative to the amount of credit dry powder that was raised. And so that gap, we don't think is going to be filled in its entirety by the banks. And so we think that there's still a lot of room for private credit to run. And what's interesting about that data is that doesn't include the growing maturity wall. So if you look at the number of credits that were invested that are coming due or maturing, the demand for fresh capital to retire that debt combined with that supply demand imbalance between the amount that's been raised, if you look at that on a 3 to 5 year basis, I think you could comfortably point to roughly a $2 trillion market opportunity for private credit.
Wow, interesting. Okay. Not only am I the host of the Private Equity Podcast, but I'm also the founder and managing partner of Raw Selection. Raw Selection is a private equity specialist executive search firm with 2 divisions, one that focuses on portfolio, C-suite executive hires, and one that focuses on private equity direct hires of the back office and investment deal professionals to the industry. Alongside the podcast, we're passionate about giving back to the industry and giving people information that they can run and utilize. One thing we do regularly every year as we run salary reports on accurate and live data of people that we've interviewed and people that have shared their information with us. So if you're looking to compare your current compensation or your compensation for your next hire in your private equity firm or portfolio company, then please check out our YouTube channel and see the playlist of salary surveys.
So two obviously significant growth opportunity for the market. Where's Hamilton Lane kind of seeing the private credit opportunities right now, and as we obviously as we go forward?
Great question. We are, I would say the way we're looking at the universe right now is our deal drivers today are largely being dominated by a few things. So number one is we've continued to see opportunities where, think of a scenario where a successful private equity has owned an asset that is performing, and that asset is continuing to go through a buy and build strategy where they may need continued access to debt financing to continue that acquisition strategy. So those incremental term loan facilities have been one big driver of opportunity for us. I'd say the second big driver has been that maturity wall that I described. So we're seeing opportunities to come in and be part of the recapitalization of the companies. I'd say to probably a lesser extent in the last year, and we see that picking up little by little. But the third flavor is really LBO financing, and where we can be part of that change of control transaction. And so I think, if I think about what gets us excited, we're, buckets 1 and 2 continue to grow. And I would say that the growth or the modest pickup in the LBO activity is driving opportunity. I think one of the things that has us pretty excited as we look forward.
Is out of interest then, is the credit market a lagging indicator then from the LBO market recovering? As you see that starts to happen, you guys get busier. Is that accurate?
It is. I think we're Hamilton Lane, we're in somewhat of a unique position as you think about how we deploy capital. You know, more broadly, our business, so if you look at one part of our business, a big part of our business is as a limited partner where we invest in other equity and credit funds. That in turn creates opportunities for us to partner with those managers in executing deals. And so we see a lot of deal flow from that channel. So despite the fact that LBO volumes have been down, over the last few years, we've actually been in the fortunate position where we've been seeing record levels of deal flow. So last year, we saw a record level that the platform hadn't seen ever. And, I think a big driver of that is our ability to really just touch a big part of the market, just given that LP position and the breadth of the relationships and the scale that we have. So I would say from that vantage point, we are in the fortunate and unique position to see deal flow, perhaps where others may be seeing less deal flow. But certainly as the LBO market picks up, as the transaction volume picks up, we expect that we'll be a beneficiary of that.
That makes sense. We hear a lot about the kind of democratization of private markets. How is this affecting you guys in the credit strategies?
It generally, in my view, is a tailwind. So just to maybe define what the democratization of private credit is when you look at the old construct, private credit in terms of how you access it was really through what we call closed-end funds. And these were largely oriented to, and continue to be oriented to, larger institutions where they are set up to be able to meet the construct, meaning they have teams to be able to evaluate these funds, and then they have middle and back offices to be able to support the funding dynamics and the capital calls and some of the administration required to participate in these types of funds. And of course, they've got the scale to access these funds at sometimes what are large minimum investment sizes with managers that maybe relationship is key to getting into those funds. In terms of the democratization effect, what we've seen is that the industry, particularly in the last 5 years, has moved more aggressively towards what we call the evergreen channel. And think of these as open-ended funds as opposed to closed-end funds. But these are open-ended funds that are really designed with more of the high net worth investor in mind, where investors day one can buy into a portfolio at a much lower minimum. So if, closed-end funds had millions at the minimum threshold, you could come into some of these funds for as little as 25 to 50,000, which is a big advantage for high net worth investors. So Lower minimums, number one. Number two is when you come into these funds, your capital is fully put to work immediately because you're basically buying into an existing portfolio of loans. And so investors really don't have the administrative friction to deal with capital calls. It's just a very clean investment where they can start earning interest income. And then thirdly, what is different from the closed-end structure is investors have the ability to control their destiny a little bit better in terms of liquidity. And so these structures are typically designed to offer a quarterly, if not monthly liquidity, and in some cases, daily liquidity, which is a big change in the industry. So as you think about the friction to get into the asset class coming down, this is really like that democratization effect where it's encouraging broader participation. And I would say the biggest uh, hurdle at this point for particularly high net worth investors is now the educational component and seeing, the benefits of private credit as an alternative to other things that can be invested in.
So what's keeping kind of you up at night at the moment? What are you worried about with regards to the future and the credit space?
Yeah, another great question. I would say it is probably the biggest thing that I think I hear as what keeps investors more broadly up at night in credit is the risk of defaults. And, I think when you look back to 2022, as rates were starting to rise, the biggest question I heard from investors around the world from that point forward was, in this rising rate environment, is higher interest expense going to break certain companies? And should we be concerned with default risk? And it was interesting because that was also a period of time where, just anecdotally, you talk to certain investors that were really starting to lean into distressed funds because I think the distressed market was starting to basically lick their chops, because there was this perspective that maybe companies were going to, run into trouble and there would be more buying opportunities for those types of managers. What we ended up seeing was that default environment turned out to be pretty benign. And so companies didn't break. We saw a lot of cooperation between borrowers and lenders. And when you look in markets like the US, which is the lion's share where private credit activity happens, we've generally had a pretty healthy consumer and we've had healthy corporates. And that has basically driven the stability um, in the ecosystem. And so, I think looking ahead, investors continue to wonder, are we headed for a default cycle? And particularly you look in the headlines now and consumer confidence seems to be waning a little bit just in the wake of some of the uncertainty coming out of the current administration's policies. But when you look at the fundamentals right now, I don't think there are any red flags that should send alarm bells to the industry. So said differently, we think that there's a lot of stability looking ahead, and the prospect for any challenges will be more idiosyncratic in our asset class. But to look at the KPIs and the data, number one is when you look at default rates and you compare those to the long-term average, we're still inside the long-term 20 to 30-year average. And so we have not seen this uptick in default rates. I think the other leading indicator is, we tend to look at what is called the distress ratio, which is more of a public markets concept. But in very simple terms, what that is you basically look at the number of credits that are trading at 80 cents or below, which is usually characterized as stress territory. And you look at that relative to the total basket of loans in circulation in that market. And when you look at that ratio, we have not seen the distress ratio, at least through recent periods, elevate above the long-term average either. So I don't think there are any KPIs, let's say at this juncture, that would lead us to believe that we are headed for any correction. Um, but I will say that investment discipline is really, really important for managers to make sure that regardless of the environment that we're in, that they are maintaining the discipline to avoid some of those challenges.
So and if we do, because there's kind of there's always three terms or main terms of belief is things are going to stay the same, things are going to get a lot worse quick, or things are going to get better. You look for guys like Ray Dalio who've been looking at the end of the US dollar for quite some time, and at some point I'm sure he'll be accurate, as history suggests that always makes a change. Maybe not to that quite extremity, but or quite extreme. But for you guys in credit, how do those cycles affect the performance of the market and how, everybody's got some kind of link to the market and performance, but private equity firms can buy lower, obviously during downtimes. It's a bit difficult when the debt interest rates are quite high, but you don't usually see massive downturns and high interest rates, but you'll see usually that come down. How does that affect the credit world?
Yeah, when you look at performance in the asset class, I think this has to be one of the single biggest attractive points for private credit investors. When you look at performance in this asset class over what has been almost a quarter century, and you look at vintage by vintage performance, private credit has had positive performance in every single year going back to roughly 99 or 2000. And if you think about it over that time period, the world has seen basically 3 market cycles over that time period. And again, it's had positive performance in every year. Not only has it had positive performance every year, but when you look at the relative performance, meaning private credit versus the public alternative. So if you look at things like the Credit Suisse Leveraged Loan Index, private credit has outperformed in every single vintage year. And what's also interesting to note is that outperformance is against the average of the asset class. So that doesn't even take into account first and second quartile performance for private credit. So it has been a very stable performer over long periods. And then when you look at it a little differently and you look at volatility in the asset class, meaning if you were to look at roughly the same time period and look at how has private credit performed in both up and down markets relative to other alternatives you could invest in, particularly in the private markets, what you see is that private credit has the narrowest dispersion of returns relative to anything else in the the private markets that you could invest in. So given that very tight band of performance that it tends to exhibit, again, in both good and bad times, we tend to view it as a very durable all-weather strategy for investors. And I think this has been a big driver. And so, while nobody knows ultimately where the world is going to go, we think that that is a pretty good indication of the stability of the asset class as you look at any potential headwinds that might exist in the macro environment going forward. Again, I'll come back to what I mentioned just a moment ago, which is, you have to control the things that are within your control and not focus on the things out of your control. And for private credit managers, what is within your control is, number one, you want to make sure that you maintain a very large deal funnel. Because if you can maintain that deal funnel, you can be very selective in the things you're doing. And if you have choice, you can maintain your investment discipline. And that investment discipline is really everything as you look forward, because ultimately you want to be able to invest in companies and capital structures that can live through different economic cycles.
I think deal flow is a certainly important element for a lot of things to keep that choice.
Not only am I the host of the Private Equity Podcast, I'm also the founder and managing partner of Raw Selection. Raw Selection's an executive search firm working exclusively within the private equity industry, supporting the portfolio companies and the private equity firms with securing exceptional talent with our motto of de-risking executive search.
So you mentioned the term deal flow. You mentioned also the term discipline in a prior answer. What's if you've got a lot of choice, that will allow you to retain that discipline side of things. And if I interpret that as discipline level of what deals, what to choose, what to go with, what's some of the things that you've done to retain that level of discipline and not get what I regard as trigger happy or overexcited about getting a deal over the line?
Yeah. We spent a lot of time thinking about this, and we spent a lot of time kind of instilling that discipline into the team here. But I would say at a very simplistic level, we tend to focus on 4 key things out of the gate as we're looking at a transaction. So I'd say number one is, and again, we have some of the benefits given the fund investment side of our business to be able to leverage these insights. But number one is when we invest, we want to make sure we're investing in a company that is backed by a leading general partner in their area of expertise. That's really, really important to us. Number two is we want to make sure that the companies we're investing in are market leading assets. And typically we define that as number 1 or number 2 in their space. I'd say number 3 is when we invest and we think about sector selection, we want to be focused on sectors that we view as being very recession resilient. So maybe another way to look at that is what areas do we tend to avoid? Energy is probably at the top of the list for us. Number one, it's not just strategy as a skill set, but number two, we just tend to view sectors like energy as being very cyclical, similar to areas like retail and things that are very consumer discretionary oriented. And then finally, we think about capital structure selection. And we want to make sure that we're investing in capital structures that we believe can move through different economic cycles successfully. And so I think the discipline around that, making sure you're investing in companies that are not over-levered. But importantly, as you look at our investment process, one of the things we want is repeatability. And so one of the things we repeat with every investment is we stress test everything that goes in through our investment committee. So every deal that goes in front of our committee will have at least a minimum of 3 different modeling scenarios where we're trying to make sure that, again, these companies can continue to service their debt under pressure.
Okay, makes sense. What are some of your influences? What do you read? What do you watch? What do you listen to? Do you recommend that others check out?
Wow, that's a broad question. I tend to consume as much as I can, but I think about consuming things probably along 3 different categories. So category number 1 is, I religiously read things like the Wall Street Journal on a daily basis just to stay abreast of what's happening in the world and in business. And there are probably a small rotation of publications in and around that I consume. I would say the second bucket that I consume is probably more what I call business reading. So think about books that tend to have more of a business theme to them. One of the books I just picked up, and I don't have too much insight around it just yet, but it was a book that was recommended to me by somebody that I think very highly of. I just picked up Poor Charlie's Almanack, which was Charlie Munger's, who was Warren Buffett's late partner. Just really a book around just kind of business and people principles. And so that's something I'm just opening up and just looking forward to getting into. So things like that would fall into that category. And then the third one is just more what I call the fun category, and things that, just kind of make you excited, feel good, entertained. Two books that I read back to back that I thought were very, very exciting in that category. I read a book called Red Notice, which is by Bill Browder. And then he wrote a follow-up book called Freezing Order, which was just 2 books that I couldn't put down. So those are probably the 3 things that I read that tend to influence kind of my view of the world. And then around the margin, I tend to read a lot of the industry publications that our peers in both the public and the private markets tend to put out.
Yeah, I'm a big fan of Charlie's book, actually. I think I kind of read it not like a typical book. I've kind of read snippets of it because it's kind of like, page chapter type stuff, isn't it? I know it's a bit longer than 9 elements, but it's a good read, certainly from there. How does anybody reach out to you if they wish to do so?
LinkedIn is probably the best place. So I can be found on LinkedIn, and my coordinates are there.
Perfect. And so thank you very much for coming on to the podcast. Appreciate your insight. Appreciate giving us perspectives on the credit world, which is not something we've openly discussed on anything previously on the Private Equity podcast. So thank you very much for coming on and sharing your journey and your experiences.
Real pleasure, Alex. Thank you.
And as always, thank you very much for everybody tuning in yet again to the Private Equity podcast. If you haven't already, please do subscribe and you'll be notified the next one that comes out every single week. But till the next time, keep smashing it, and thank you very much for listening.